Hello everyone, and welcome to this week's Market Recap, where we review key developments that have shaped markets, highlight what drove our recent performance, and look ahead to important events on the horizon. Let's start with what moved markets this past week. The big story is that artificial intelligence continues to capture investor imagination and drive stock prices higher, pushing major indexes to fresh record levels. U.S. stock markets have climbed to new highs as excitement around AI technology reaches a new peak. A major funding announcement valued OpenAI at $500 billion, reminding everyone just how transformative this technology is becoming. Leading AI companies like NVIDIA and Broadcom posted strong gains, while Tesla also rose on better vehicle sales. What's remarkable is how the market has maintained momentum even with uncertainty from Washington's government shutdown. Investors seem increasingly confident the Federal Reserve will support growth with rate cuts, helping to sustain this AI-driven rally. For our portfolios, this environment continues rewarding our positions in innovative technology leaders. These aren't speculative bets. They're investments in companies already generating real profits from AI applications happening today. The bond market saw significant gains this week after employment data revealed surprising weakness. The ADP report showed companies actually reduced payrolls by 32,000 in September, a sharp reversal from expectations of job growth. This news sent Treasury yields falling, with the 10-year note dropping to 4.10% and the 2-year to 3.55%. With the usual government jobs report delayed by the shutdown, traders are relying more on private indicators, making releases like ADP even more important. When employment softens this quickly, it can shift policy expectations dramatically, creating opportunities for bond investors through both income and potential price gains. Beyond the headline number, the employment details revealed concerning trends worth monitoring. This marks back-to-back monthly declines in private hiring, with losses concentrated in leisure, business services, and manufacturing. Only education and healthcare showed job growth. While part of the weakness stems from technical data adjustments, the underlying softness is real. The Federal Reserve has already begun cutting rates and is watching the job market closely. If weakness continues, we could see the Fed accelerate rate cuts, supporting bonds and rate-sensitive investments, while potentially creating caution in consumer-dependent stocks. These developing trends guide how we position our portfolios for changing economic conditions. Now let's look at what drove our performance over the past week and why we remain confident in our positioning. NVIDIA was our standout performer with a 6.3% gain, continuing its role as the flagship AI investment in our portfolios. The company benefits from ongoing momentum in AI infrastructure spending, where demand for its advanced graphics processing units shows no signs of slowing. What sets NVIDIA apart isn't just making chips for AI, it's built an entire ecosystem that makes it nearly irreplaceable for companies building AI capabilities. Recent industry updates confirm that major cloud providers and enterprises continue expanding their AI data centers with NVIDIA's technology at the core. Despite elevated valuations, NVIDIA represents our conviction in owning the leaders of transformative technological shifts that are already reshaping how businesses operate. The information technology sector led our performance again, with nearly every major holding contributing positive returns. NVIDIA's 6.3% surge stood out, while the semiconductor equipment maker ASML gained 8.5% and Microsoft rose 1.7%. Broadcom and Apple also posted solid gains. Several powerful trends are working in technology's favor: businesses racing to implement AI capabilities, governments incentivizing domestic chip manufacturing, and robust investment pipelines from cloud providers. Our technology companies aren't just benefiting from temporary enthusiasm, they're positioned at critical points in supply chains for technology, reshaping entire industries. They generate enormous cash flows, maintain technological advantages, and are exposed to trends driving economic growth for years ahead. Our size strategy delivered the strongest contribution this week, reflecting how investors continue gravitating toward the largest, most established companies. NVIDIA led with a 0.58% weighted contribution, while Tesla added 0.16%, and Eli Lilly contributed 0.14%. This represents a clear flight to quality. When questions arise about the economy or policy, investors seek companies with resources to navigate challenges. Large-cap companies possess advantages smaller competitors can't match: financial strength to weather storms, global reach to capture opportunities, and capital for next-generation technologies. They better navigate complex regulations and adapt to policy changes that might challenge smaller businesses. We see their leadership as earned through superior execution and sustainable competitive advantages. Looking ahead, here are the key events we're monitoring that could shape the markets in the coming week. Tuesday, October 7th brings an important update on consumer inflation expectations from the Federal Reserve Bank of New York. This monthly survey asks everyday Americans what they expect inflation to be over the next 1, 3, and 5 years. While actual inflation data tells us what happened, expectations data reveals what consumers think will happen, which matters enormously because expectations can become self-fulfilling. If people expect higher inflation, they may demand larger wages and accept higher prices, actually driving inflation up. Recent surveys show one-year expectations hovering around 3.2%, above the Fed's 2% target. The Fed watches these numbers closely because keeping expectations anchored near 2% is crucial for price stability. Rising expectations could signal persistent inflation, limiting how aggressively the Fed can cut rates. Stable or falling expectations would suggest that consumers believe the Fed has inflation under control. Thursday, October 9th brings an important speech from Federal Reserve Chair Jerome Powell that could provide insights into the central bank's thinking on rates and the economy. Powell's public comments are always closely watched because even subtle language shifts can signal policy changes. At the Fed's September meeting, officials cut rates by 0.25% and indicated more reductions were likely if conditions warranted it. Since then, we've seen mixed signals, with employment showing unexpected weakness while inflation remains somewhat elevated. Powell will likely address how the Fed is balancing these competing concerns, such as supporting the job market through rate cuts, while making sure inflation continues to decline toward 2%. He may also discuss how the government shutdown and delayed economic data are affecting Fed decision-making. For markets, Powell's tone matters as much as his specific words. Any hints about the pace of future rate cuts, whether gradual or more aggressive, could move both stock and bond prices significantly. Also on Thursday, October 9th, the weekly Jobless claims report typically provides our most timely employment reading. However, this week's data may be affected by the current ongoing government shutdown. When available, this update will offer important insights following the surprisingly weak ADP data. Before the shutdown, the claims ran around 224,000, suggesting a relatively healthy job market. However, given September's sharp reversal in private hiring, this weekly update could reveal whether businesses are reducing staff more broadly. Employment trends matter enormously because consumer spending drives roughly 70% of economic activity. Rising claims could signal softening that prompts faster Fed action, while stable numbers would suggest the ADP weakness might be temporary. As always, we remain focused on what matters most, helping you achieve your long-term financial goals through disciplined investing and thoughtful portfolio management. Thanks for joining us, and we'll see you next week.